Okay, folks, welcome to part two of our series on trading strangles. And in this situation, we're trading Amazon. This is, again, part two of our Amazon trade. And our bet on this trade, we used a ratio strangle. Our bet on this trade that Amazon would break down to new lower lows. And we have that breakdown. The bet is paying off. So the shares of Amazon on the day since our last video are down about 6% or $6.14. So let's take a look at how our trade is doing, and let's talk about next steps. And those next steps are managing winners. Now, in looking at our P&L on this trade, you'll note that our P&L is actually less than what it was this morning, despite the trade going in our direction. Why might that be? Well, the reason is that despite the fact our bet that Amazon would break down to new lower lows, the implied volatility on the shares has increased. Let's take a look. Now, you remember that the implied volatility had dropped down to around, I think it was around 52 to 53, around there during the last video. We are now back up to 57% on implied volatility, implying that you're seeing speculators move in, they're bidding up the value of the put options, resulting in IV, implied volatility expansion. So what do we need to do in this scenario? Well, we need to manage our winners. Let's go take a look at what that looks like. Now, in managing your winners, you want to look at, I'm a student of Tasty Trade in terms of managing winners, and you want to manage winners at 50% or greater. And in this situation, we need to remember the whys behind we got into this trade. And the why is that we were bearish on the trade and we set our strikes at a 10 delta. And again, if you didn't watch part one of this video series on this Amazon strangle trade, please go back and check it out. Now, you'll note that the call side options, which is a bearish play because we're short of those options, we're seeing at current a profit of nearly 60% or $251.04. Whereas the put side of the trade is showing us a loss of $188.50 or nearly 67%, but still net on the trade, we're up. So how do we manage this trade? Well, we need to do a couple of things. One, are we still bearish on the trade? Well, yeah, I am, because when you take a look at a weekly chart of Amazon, we now have a new weekly lower low. Now, that being said, tomorrow we have a Federal Reserve meeting, and if they are dovish, well, that could send tech stocks higher. We're also at historical support at $95.87 on Amazon. So we may see a rally here. So unlike what Tasty Trade does, what we do is we incorporate technical analysis in with our options trading. Now, given that we are at historical support, we want to be very conservative with rolling down our winners, rolling down our call side, and this is how we do it. So we're going to go in, we're going to select our strike, which is at current at $125. Remember, we opened this trade at a 10 delta. What do we want to do? We want to roll out, and we want to keep the same expiration, and we want to select a strike at a 10 delta. Note that our current strike was a 10 delta. It is now only a 5 delta. Now, the new strike that we're going to select, 10 delta, $117 strike price to the call side. That'll generate us a new credit of $228. Before we leave this screen, what I want to do is, A, take note of our profits at current so we could track our return on capital. So our profit at current on the Amazon calls is $245.04. So we're going to roll from 125 down to 117, same expiration date, same number of contracts. We'll see whether or not we get filled at the midpoint. Again, the credit after commissions is $226.07. That order is in. Now, as you're waiting for this fill, take note of the time. We try to roll these trades as close to the close. We're on the East Coast, so this is Eastern Standard Time, 3:41 in the afternoon. And the reason we do this is because market players, the big institutions, they really make. We just got filled on our order. We have now rolled out that trade. We have a fill. Market participants, the big institutions, make a lot of their trades in the final hour of trade. So we didn't want to get whipsawed on this trade by rolling down too early in the day, then having the shares turn positive by the end of the day, and we are not in a strong position. So now we've rolled down this trade, and here is the new position. These are 117 calls, 6 contracts, same expiration date, and now take note of our deltas. They're now more balanced out. Now here's what our deltas look like after the roll down. You can see that our put side delta expanded from when we opened up this trade. It was at a 10 delta, now at a 16 delta. Our call deltas, we just opened them up at a 10 delta, or I should say rolled down to the 117s from the 125 to a 10 delta. It's expanded a little bit here, that's fine. And now we are balanced out far more appropriately than we were only a few minutes ago on our deltas. It's very important to manage your winners, keep these balanced out. Now let's take a look at how we look on our probability of profit on Thinkorswim. Okay, so right now we have on the call side roughly a 77% probability of profit, and on the put side roughly an 60% probability of profit. So this is still a favorable trade for us. We've already booked some profits on it, and the goal here is to close out the trade at 21 days or 50% profit. If you got any value out of this video, please like, subscribe, join the Contrarian Trader, get 14 days free. Don't forget to check out part 1 of this video series by clicking the video immediately above.